Ever get that feeling like you're swimming upstream in a sea of financial info, just wishing someone would hand you the Cliff's Notes to understanding your money?
Yeah, it can be overwhelming.
Well, welcome to the deep dive. That's exactly what we do. We sift through the documents, the data, all the noise, and pull out the key insights that really matter.
And today, we're taking a deep dive into a resource one of you shared with us, a document titled Saving Your Future EV 2022-2018 2.pdf, a revised edition from 2018 by Express WSB.
That's right. And this isn't some dense textbook, is it? The book itself says it aims to explain finance simply, like a friendly chat about the core principles of how money works for everyday folks.
Specifically for people in the U.S. and Canada.
And they do make a key point. This is for general understanding, not personalized financial advice.
Which is an important distinction, definitely. Our goal today is to extract those crucial foundational ideas. We're going to unpack the insights from this book to help you, our listener, get a clearer picture of your financial future.
Sounds good. Covering everything from the fundamental rules to the various tools available.
Exactly.
Okay, let's unpack this. The book starts by looking at the financial landscape around 2018, using surveys to highlight some, pretty significant challenges facing people in North America. What struck you as particularly important in their view of that time?
Well, what's interesting is how persistent some of these challenges seem to be. Even back then, a significant number of Canadians were struggling just to cover their monthly expenses.
Really, just getting by month to month.
Yeah, and many were very close to being insolvent. And retirement savings, worryingly low for a large portion of Canadians nearing retirement age.
And this wasn't just a Canadian issue, was it? The book mentions similar findings in the U.S.
Right, pointing to a widespread kind of lack of understanding about basic financial concepts and products, too.
It makes you wonder how much has fundamentally shifted since 2018.
It does. The book also puts this into the context of the economic roller coaster of the early 2000s, you remember. The Y2K anxieties, the dot-com crash,
Oh, yeah.
Point 911, and then, of course, the 2008 financial crisis. Big stuff.
Huge impacts.
And these events had a deep impact on families. People lost home equity, savings got depleted, job losses, even bankruptcies.
That was a tough period for a lot of people. And then you add in the demographic shifts. You talk about the aging baby boomers, the pressures on Gen X caught in the middle.
Right.
And the economic hurdles facing millennials, like the global job market and increasing automation. It sounds like, a recipe for financial stress.
Exactly. The book also points to a significant change in how we handle finances. The increased ease of getting into debt, loans, credit cards.
Everywhere.
Which led to a big jump in consumer debt. As they put it, living with debt became almost normal.
So it's a pretty serious picture they paint. But they do offer a bit of hope, mentioning that public awareness of personal finance did increase after the 2008 crisis. In your opinion, did that increased awareness lead to significant change?
That's the big question, isn't it? I mean, while people might have been more aware, the core issues they point out, the lack of widespread financial literacy, the burden of debt, the uncertainty around retirement, many of those are still very much present today, which really underscores why the book emphasizes this idea of individuals needing to take more self-security, as they call it, into their own hands.
Right. They discuss how the traditional ways people used to rely on for retirement security are less certain now. And let's dig into that. What are these pillars, and why does the book suggest they're, shaky?
Okay, so the book identifies three mainstays: your own personal savings, company pensions, and government programs like Social Security in the U.S. and the Canada Pension Plan, or CPP.
Got it.
The uncertainty comes from a few directions. First, personal savings, like we just touched on. A large percentage of people in North America living paycheck to paycheck find it incredibly difficult to save consistently.
It's hard to put money aside when you're just trying to cover the bills each month.
And what about company pensions? I know that landscape has shifted quite a bit. Absolutely. We've seen a huge move away from defined benefit pensions, the kind that promised a specific income in retirement.
The old gold watch and pension kind of deal.
Sort of, yeah. Now it's mostly defined contribution plans like 401k. And the shift puts the responsibility and, importantly, the investment risk directly on the employee.
So your retirement income isn't guaranteed anymore. It depends on how your investments actually do.
Precisely. That definitely adds a new level of responsibility and potential worry for individuals.
And the last piece, government programs.
Yeah.
Social Security, CPP. Are they facing challenges as well?
Yes. With a growing number of retirees compared to the number of workers contributing, there's increasing pressure on the long-term sustainability of these programs.
Makes sense. The demographics are shifting.
Right. The book even gives an example, noting that the maximum monthly CPP benefit back in 2015 was around 11,134 Canadian dollars. It makes you ask, is that realistically enough for a comfortable retirement on its own?
Probably not for most people. It really makes you think about the bigger picture. So with these traditional pillars becoming less reliable, the book strongly emphasizes the need for individuals to become more self-reliant, take charge of their own financial futures. How do they recommend we actually do that?
They use a really helpful analogy, thinking of building your financial life, like building a house. You got to start with a strong foundation.
Okay, I like that.
They outline 4 key layers. First, you need protection, having adequate insurance in place.
Insurance first, okay.
Second is managing your debt effectively. Third is building an emergency fund, that crucial safety net of, say, 3 to 6 months of living expenses.
Right, the rainy day fund.
Exactly. And finally, the 4th layer is long-term investment.
Protection first, that makes perfect sense. You
Yeah.
wouldn't want one unexpected event to wipe out any progress you're making on the other layers, right?
Precisely. They stress that if you don't have that base level of protection, any savings you're trying to build can be quickly undone by things like a serious illness or an unexpected disability.
And tackling debt before really focusing on investing also seems like a logical order. Get that out of the way.
Yeah, reduce those drains on your resources first.
Now, the book then moves into what they call understanding how money works. And they introduce a wealth formula. Okay, let's break down this formula. What are the key ingredients?
Right. The formula is money plus time plus light rate of return inflation tax wealth.
Okay.
It's a simple but pretty powerful way to visualize the main factors that will influence your financial growth over time.
So it's not just about how much money you start with. It's also the time your money has to grow, the returns you earn.
And crucially, the impact of inflation and taxes. Those last 2 subtract from your wealth.
Got it. They also discuss some core principles related to this formula, starting with pay yourself first. What's the core idea behind that? We hear that phrase a lot.
Pay yourself first is really about making saving a priority, non-negotiable almost. The book suggests setting aside a percentage of your income, say anywhere from 5 to 15% or even more, for your future first.
Before you pay other bills or spend on anything else.
Exactly. Treat it like a bill you absolutely have to pay each month. It's about putting your long-term financial well-being at the top of your list, not saving whatever might be left over, if anything.
That makes total sense. It's a shift in thinking. They also talk about buy only what you need, a concept that seems pretty obvious but can be surprisingly difficult to stick to in our consumer-driven world, eh?
Oh, absolutely. It really comes down to distinguishing between your essential needs and your wants, and being really conscious of your spending habits. Where's the money actually going?
Those little daily things add up.
They really do. The book even uses some compelling hypothetical examples, shows how small, seemingly insignificant daily expenses, like that daily coffee or takeout lunch, can add up to substantial savings over the long run if you cut back.
It's often those little daily habits that have a bigger impact than we realize. Then they move on to the element of time, which you mentioned in the formula. And they use a classic comparison between Mr. Start Early and Mr. Wait Longer. Can you walk us through that scenario?
Yeah, this is a really powerful illustration of the magic of compounding. So Mr. Start Early begins saving a certain amount consistently for just 7 years early in his career, and then stops contributing altogether.
Okay, just 7 years of saving.
Right. Then Mr. Wait Longer waits those same 7 years, does nothing, and then starts saving the exact same amount consistently, but does it for a much longer period, say 30 or 40 years.
So Mr. Wait Longer saves for way more years in total.
Exactly. But the surprising result is that Mr. Start Early, who only saved for 7 years, ends up with significantly more money in the long run.
Wow. Just because he started sooner.
Precisely. Because his early savings had so much more time to grow and benefit from compound interest. The key takeaway here isn't just about saving for longer, it's about the lost opportunity cost for those early dollars to multiply for decades. It shows the incredible leverage of starting early, even if the amount seems small.
That's a really compelling case for not putting off saving for the future. Get started, even small. Next up is rate of return and compound interest, which can sound a bit technical, but the book aims to make it understandable, right?
Absolutely. They explain the rule of 72 as a handy shortcut. It helps you estimate how long it'll take for an investment to double at a given interest rate. You just divide 72 by the annual rate of return.
Okay, so like 72 divided by 6% interest means roughly 12 years to double.
Roughly, yeah. It's a quick ballpark. They also emphasize the crucial difference between actively working for your money,
Trading time for dollars.
right, versus having your money work for you. And understanding compound interest is absolutely key to making that leap.
Makes sense.
Importantly, they also point out that while compound interest can be a powerful wealth building tool when you're saving.
It can also work against you.
Exactly. It works against you when you have debt, especially high interest debt like credit cards.
That's a critical point that sometimes gets lost. That debt can really spiral because of compounding working the wrong way.
Totally. The book even provides a clear example showing the difference between simple interest and compound interest on, say, a $10,000 investment over 30 years. The difference in the final amount is pretty staggering.
Demonstrates that exponential growth.
Yes, compared to just linear growth with simple interest. Then they tackle the concept of inflation, which is something we're all very aware of lately.
Definitely feeling that now. How does the book explain the impact of inflation on our wealth?
They define inflation simply as the gradual decrease in the purchasing power of money over time. Essentially, what a dollar buys today, it will buy less of tomorrow.
So your money becomes less valuable.
Right. That's why your savings need to grow faster than inflation just to maintain their real value. Forget about growing wealth for a second. You need growth just to tread water against inflation.
That's a good point.
They provide examples of how the cost of everyday goods has increased significantly over past decades, and illustrate how inflation can erode the future value of your savings. Like showing how a retirement income of $4,000 a month in today's dollars will require a much, much larger sum in the future just to maintain the same standard of living.
It's a stark reminder. Your savings need to not only grow, but outpace inflation to maintain their real value over the long haul. And finally, in their wealth formula, they address taxes, something that's, well, a certainty for all of us.
As the old saying goes, right? Nothing's certain but death and taxes. The book certainly echoes that. They have a brief historical overview of U.S. income tax rates.
Which have varied a lot over time.
A lot. And emphasize that taxes will impact our money at various stages when we earn it, when it grows, when we spend it. They also touch on some future challenges, like that shrinking worker-to-retiree ratio we mentioned, which could potentially lead to higher taxes down the line to fund things like Social Security.
That's a sobering thought to consider. Future tax rates might be higher than today's.
It's definitely a possibility to factor in. The book then delves into tax now, tax later, and tax-advantaged accounts. This can be a bit confusing for people. Can you give us a quick rundown of these categories and some common examples?
Sure. So tax now accounts are basically your standard taxable accounts. Think regular savings accounts or brokerage accounts where you invest outside of retirement plans. Any interest, dividends, or capital gains are generally taxed in the year you receive them.
Okay, pay as you go, essentially.
Pretty much. Then you have tax later accounts. These are things like traditional IRAs and 401ks in the US or RSPs in Canada. The big benefit here is that your contributions might be tax deductible now and your money grows tax deferred.
Meaning you don't pay taxes on the growth each year?
Right. But you will pay income tax on the withdrawals when you take the money out in retirement. So you pay the tax later.
Got it. And tax advantaged.
These are often the most powerful, things like Roth IRAs and Roth 401ks in the US or TFSAs in Canada. Here, you contribute money after you've already paid taxes on it, so no upfront tax deduction.
Okay.
But the magic happens later. The money grows tax-free, and then qualified withdrawals in retirement are completely tax-free.
So you pay tax now, but potentially avoid much higher taxes later on all the growth.
Exactly. The book also briefly mentions capital gains tax the difference between short-term and long-term gains and presents different viewpoints like, is it better to pay taxes now when rates might be lower or defer them?
It really underscores how important it is to understand the tax implications of the different ways we save and invest. It's not just about the rate of return.
Definitely not. Now, after laying this foundational understanding, the book moves into specific areas like debt management. What are some of their key recommendations for getting debt under control?
Their advice is very practical, very actionable. First, stop digging the hole deeper, right? Don't take on more debt. Live within your means.
Easier said than done sometimes, but crucial.
Absolutely. They even suggest avoiding carrying credit card balances altogether. Maybe use cash or debit cards instead to control spending. Focus spending on essential needs first.
Needs versus wants again.
Exactly. Make a comprehensive list of all your outstanding debts. Know exactly what you owe and to whom, and then actively work to pay them off. They often suggest the snowball method, tackling smaller debts first for that motivational win.
Get some momentum going.
Yeah. Or the avalanche method, paying off the highest interest rate debt first, which mathematically saves more money. The key is having a plan and sticking to it.
And they have that mortgage example too, right?
Oh yeah, the mortgage prepayment example is really powerful. It shows how making even small extra payments towards your principal can significantly reduce the total loan term, shave years off your mortgage, and save you a ton in interest over time.
That's really eye-opening. Shows the long-term benefits clearly. Next, the book introduces the X-curve concept, which is a visual way of thinking about our financial lives as we progress. Can you explain what that concept illustrates?
Sure. The X-curve is a visual way to think about two lines crossing over time. One line represents your financial responsibilities, things like raising kids, paying off the mortgage, education costs. This line typically starts high when you're younger and gradually decreases.
Great. Responsibility goes down over time.
Ideally, yeah. The other line represents your accumulated wealth, your savings, and investments. This line ideally starts low and increases over time as you save and invest.
So wealth goes up.
Right. They form an X shape. The responsibility curve slopes down. The wealth curve slopes up. The point where they intersect is, theoretically, when your accumulated wealth is sufficient to cover your remaining responsibilities. You've become self-insured, in a sense.
It's a really useful visual for thinking about that interplay between building assets and reducing our financial obligations as we get older. How do our insurance needs fit into this X-curve framework?
It fits perfectly, actually. Early on, when your responsibilities are high and your wealth is still low, that gap between the two lines is large. Your need for protection, like life insurance, is typically greatest. It protects your family if something happens to you before your wealth curve rises.
So insurance fills that gap.
Exactly. Then, as your wealth grows and your responsibilities lessen over time, that gap narrows, and your theoretical need for life insurance might decrease.
That makes sense, but the book adds a caution, right?
Yes, a very important one. They caution that some individuals actually increase their debt as they age, maybe taking out home equity loans, running up credit cards again. This pushes the responsibility curve back up or keeps it high, undermining the whole benefit of the X-curve.
So it requires discipline.
Absolutely. Ultimately, they emphasize that financial responsibility is the key to making the X-curve work in your favor, making conscious choices to save and reduce debt over time.
Moving on, the book dedicates a significant section to understanding life insurance. Why do they place such a strong emphasis on this particular topic? Seems like a core part of their protection first idea.
It absolutely is. They emphasize that life insurance is a crucial component of a sound financial plan, but its primary purpose is financial protection for your loved ones if you die prematurely. It's not really an investment for you.
It's for the people who depend on you.
Precisely. They point out the common skepticism people have towards life insurance, like, I won't benefit from it, even while people readily insure their cars or homes, which are often less valuable than their future income stream.
That's a fair point. We insure stuff, but maybe not our ability to earn.
Right. And they stress the importance of considering your insurability. Your health matters. Getting coverage often requires medical exams, and existing health issues can lead to higher premiums or even denial of coverage.
Sooner's better, usually.
Generally, yes, especially while you're younger and healthier. They even include some sobering statistics on the prevalence of conditions like heart disease and cancer in both the US and Canada to highlight why securing coverage early is important.
And how do they suggest people figure out how much life insurance coverage they might actually need? It's like a big question.
They introduced the DIME method as a helpful framework. It's an acronym.
DIME.
Yeah. D stands for debt, covering all outstanding debts except the mortgage. I is for income replacement. How many years of your income would your family need? M is for mortgage paying off the home loan. And E is for education funding future education costs for children.
Okay, debt, income, mortgage, education. That gives you a concrete way to estimate the need.
Exactly. It helps quantify the potential financial gap. They also make the important point that stay-at-home parents absolutely need life insurance too. Think about the economic value of the services they provide: childcare, household management. Replacing that would cost a lot. Salary.com even estimates this value.
Good point. And they even say single people might need it.
Yes, for reasons like covering personal debts so they don't burden family, paying final expenses, or maybe leaving a legacy or charitable gift.
So it's not just for the traditional breadwinner scenario. The book then gets into the specifics of how to buy life insurance, discussing the cost per $1,000 of coverage and the different types. This can be a bit overwhelming term versus permanent. Can you break down the core
Oh,
differences?
sure. They explain the basic cost. The cost of insurance, or COI, is essentially the annual price for each $1,000 of death benefit. And this cost generally increases as you get older and your risk of dying increases.
Makes sense.
Then you have the main categories. Term life insurance is presented as temporary coverage. It lasts for a specific period or term like 10, 20, or 30 years. If you die during that term, your beneficiaries get the death benefit. If you outlive the term, the coverage ends unless you renew it, likely at a much higher rate.
So pure protection for a set time, usually more affordable.
Generally, yes, especially when you're younger, because it doesn't build cash value. There are variations too, like decreasing term, often sold as mortgage life insurance, where the coverage drops as your mortgage balance drops. And even return of premium term, where you might get your premiums back if you outlive the term, but it costs more upfront.
Okay. And permanent life insurance.
Permanent life, like whole life, is designed to provide lifelong coverage as long as you pay the premiums. The key difference is it includes a cash value component that grows over time, usually on a tax-deferred basis.
So it's insurance plus a savings or investment element.
Kinda, yeah. Whole life typically has fixed premiums, a guaranteed minimum interest rate on the cash value growth. But the cash value builds relatively slowly, especially in the early years, and there can be surrender charges if you cancel the policy early.
And they discuss the buy term, invest the difference strategy.
They do. It's a popular concept. Buy cheaper term insurance and invest the money you save compared to a permanent policy premium. The book points out, though, that for this to work, you need the discipline to actually invest the difference consistently, and you need decent investment knowledge or advice. Plus, there's the risk your investments might underperform.
So it requires diligence. Term is simpler protection. Permanent offers lifelong coverage plus cash value, but costs more.
That's a good summary. The book also touches on some additional products in the U.S., things like Universal Life, UL, and Index Universal Life, IUL.
How are those different from whole life?
Universal Life offers more flexibility than whole life. You can often adjust your premium payments and sometimes the death benefit amount within certain limits. The cash value growth is often tied to current interest rates, so it can be more variable than whole life's guarantees.
IUL.
IUL is a type of UL where the cash value growth is linked to the performance of a stock market index, like the S&P 500. But, and this is key, it usually comes with caps limiting your maximum potential return in good years and floors protecting you from losses in bad years, often guaranteeing a 0% return floor. It's more complex.
So potential for better returns than fixed rates, but with limits and some downside protection.
Exactly. For Canada, they also mention Universal Life, which might offer different investment options, and segregated funds, which are kind of like mutual funds offered by insurance companies, bundling insurance guarantees with investment management.
Lots of options. The book's main message seems to be choosing what fits your needs and budget.
Absolutely. Suitability and affordability are key. There's no single best type for everyone.
Makes sense. They also briefly cover other specialized types, right? Like accidental death, joint life.
Yeah, just briefly. Accidental death and dismemberment, AD&D, pays out only for accidents. Joint life policies cover two people, paying out either on the first death, first to die, or the second death, second to die, often used for estate planning. Key person insurance for businesses, executive bonus plans, final expense insurance for burial costs.
Lots of niche uses. And they also discuss living benefits, which sounds interesting. That's accessing the money while you're alive.
Yes, living benefits, also known as accelerated death benefits, are riders or features on many policies now. They allow the policyholder to access a portion of their death benefit while still alive if diagnosed with a qualifying critical, chronic, or terminal illness.
That could be incredibly helpful for medical bills or care costs.
Definitely. It provides financial resources during a really challenging time. And finally, they wrap up the insurance section highlighting the significant tax advantages.
What are the main ones?
Three big ones. First, the death benefit paid to beneficiaries is generally received income tax-free. That's huge. Second, the cash value growth inside a permanent policy accumulates tax-deferred. Third, you can often access that cash value through withdrawals up to your cost basis, or policy loans, potentially tax-free, though loans accrue interest and reduce the death benefit if not repaid.
Those tax advantages can certainly be a significant factor in long-term financial planning, especially the tax-free death benefit. Okay, next up in the book are understanding annuities. These often come up in retirement income planning. What's the primary purpose of an annuity, according to the book?
The book explains that annuities are primarily designed to address the risk of outliving your savings in retirement, longevity risk.
So life insurance protects against dying too soon. Annuities protect against living too long.
That's a great way to put it. They can provide a stream of income that you can't outlive. They broadly categorize them into deferred annuities and immediate annuities.
Deferred versus immediate. What's the difference?
With a deferred annuity, you typically contribute money over time, or maybe a lump sum, and it grows tax-deferred during the accumulation phase. You start taking withdrawals later, usually in retirement.
Okay, grow now, pay out later.
Right. With an immediate annuity, you usually fund it with a single lump sum, maybe from savings, or a 401k rollover, and the payments start almost right away, typically within a year.
Lump sum in, income stream out quickly.
Exactly. So annuities are essentially about converting a lump sum of savings into a future income stream. The book calls it a reverse bet on longevity. The insurance company is betting on average lifespans. You're ensuring you have income even if you live longer than average.
And what are some of the different ways you can actually receive those payments, the payout options?
They outline several common ones. You could choose period certain, where payments are guaranteed for a specific number of years, say 10 or 20. If you die before then, your beneficiary gets the rest.
Okay, guaranteed for a set time.
Or you could choose lifetime payment, where you receive payments for as long as you live, but they might stop when you die. Lifetime payment with period certain combines these payments for life, but also guaranteed for a minimum number of years.
Provides a bit more security for beneficiaries.
Well, yes. And joint and survivor annuities provide payments for as long as either you or your spouse is alive. Very common for couples. They also mention newer features like guaranteed lifetime income withdrawal riders, which offer more flexibility to access funds while still guaranteeing income.
Lots of ways to structure the income. And how do these annuities earn interest or grow?
Good question. They discuss different interest strategies. A fixed annuity pays a guaranteed interest rate for a set period, simple and predictable. A fixed index annuity, similar idea to the IUL we discussed, links your interest crediting to a market index, again, usually with caps on the upside and floors, often 0% protecting the downside. These also often have surrender charges if you take money out early.
So annuities can be a valuable tool for creating a predictable income stream in retirement and managing that risk of outliving your money. The book then transitions into investment basics, starting with an overview of the capital markets. What fundamental concepts do they cover here?
They cover the real basics, how capital markets work. The difference between the primary market, where new securities, like stocks in an initial public offering, IPO, are first sold to investors.
Okay, the first sale.
And the secondary market. That's where existing securities are bought and sold between investors. Think stock exchanges like the NYSE or NASDAQ.
Where most everyday trading happens.
Exactly. They define stocks as representing ownership equity in a company and bonds as essentially being loans, debt instruments, where you lend money to a government or corporation.
Owner versus lender. Got it.
They also explain market indexes, the Dow Jones, S&P 500, NASDAQ, TSX in Canada, international indexes. These are just benchmarks used to measure the performance of a specific segment of the market. And they briefly mention the money market as a place for short-term, generally low-risk debt securities, distinguishing between bank money market accounts and brokerage money market funds.
So the building blocks. And then they delve into mutual funds, which are a very common way for people to invest, right?
Extremely common. They describe mutual funds as pools of money collected from many investors. That pool is then invested and managed by professionals according to a specific objective, like growth or income.
So you get diversification and professional management.
Those are the key advantages they highlight. Professional management, diversification, owning small pieces of many different securities, liquidity, usually easy to buy and sell shares, relatively low investment minimums compared to buying individual stocks, and general ease of use.
Sounds pretty good. What are the downsides?
Well, the big one is there are no guarantees. Unlike a bank account, you can lose money in a mutual fund if the underlying investments go down. And fees. Mutual funds have various fees and operating expenses like sales charges or loads, and annual expense ratios, which reduce your overall return.
Fees definitely eat into returns over time. How do you actually make money from them?
3 main ways, according to the book. First, through income distributions. If the fund holds bonds that pay interest or stocks that pay dividends, it passes those earnings along to shareholders. Second, capital gains distributions. If the fund manager sells securities within the fund at a profit, they distribute those gains. Third, increase in NAV. NAV stands for net asset value, which is the price per share. If the value of the fund's underlying holdings goes up, the NAV per share increases, and you make money when you sell your shares for more than you paid.
Okay, income, capital gains, and price appreciation. They also briefly mention ETFs, exchange-traded funds.
Yes, just briefly. ETFs are similar to mutual funds in that they're pooled investments tracking an index or sector, but they trade on stock exchanges throughout the day, like individual stocks, whereas mutual funds are typically priced once a day at the NAV.
Got it. Diversification is a major plus for funds, but as the book rightly points out, it doesn't guarantee profits or stop losses entirely. They also briefly discuss variable life, variable universal life, and variable annuities. How do these differ from the fixed versions we discussed earlier?
The key difference with these variable products, whether it's life insurance or an annuity, is that the cash value or account value is not tied to a fixed interest rate. Instead, it's invested in underlying investment options, often called sub-accounts, which are very similar to mutual funds.
So you choose the investments.
Typically, yes. The policyholder selects from a menu of sub-accounts. This introduces the potential for higher growth if your chosen investments perform well.
But also the potential for loss.
Exactly. It carries investment risk. If those underlying investments decline in value, your cash value or account value can decrease. There's no floor like in fixed index products usually.
So with the potential for greater returns comes greater investment risk and likely a need for the individual to be more actively involved in managing those choices.
That's right. The book then provides some really important considerations when investing. This seems crucial. What are some of the key takeaways from this section?
They start with that vital disclaimer. Past performance is no guarantee of future results. You hear it all the time, but it's true.
Can't stress that enough.
They emphasize understanding your own investment objectives. What are you trying to achieve? And your personal tolerance for risk. How much volatility can you stomach? And how does that relate to your time horizon? How long until you need the money?
Short-term needs require lower risk. Longer-term goals can potentially handle more volatility for higher growth potential.
Right. They strongly advocate that time in the market is generally much more effective than trying to time the market, jumping in and out based on predictions.
Trying to time the market is notoriously difficult, even for pros.
Yeah, they provide historical data on S&P 500 returns over different holding periods, 1 year, 5 years, 10 years, 20 years, showing how the range of outcomes narrows and the average returns tend to improve the longer you stay invested. Volatility smooths out over time.
That long-term perspective is key. What about diversification and allocation?
Huge emphasis on asset allocation. That means spreading your investments across different asset classes, like stocks, bonds, cash, maybe real estate or commodities. The idea is that different asset classes often behave differently, so diversification can help reduce overall portfolio risk. They note your ideal allocation might change as you age, typically becoming more conservative as you approach retirement.
Makes sense. Shifting from growth focus to capital preservation.
Exactly. They also explain dollar cost averaging.
Ah, yes. Investing a fixed amount regularly.
Right. Investing, say, $100 every month, regardless of whether the market is up or down. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, this can potentially result in a lower average cost per share compared to investing a lump sum all at once. Though they caution it doesn't guarantee profit and can be less effective in a steadily rising market or painful in a prolonged down market.
It's more about disciplined investing and mitigating timing risk. And what about understanding risk itself?
They delve into that, particularly the sequence of returns risk. This is crucial, especially near retirement. The order in which you experience gains and losses matters. A big loss early in retirement, when you start withdrawing money, can devastate a portfolio much more than the same loss occurring later.
Recovering from losses requires even higher gains, right?
Exactly. A 50% loss requires a 100% gain just to get back to even. So managing downside risk becomes more important.
And the emotional side of investing.
Big point here. Don't be too emotional. Market volatility is normal. Swings happen. The danger is letting fear drive you to sell low during a downturn, or letting greed drive you to buy high during a peak. They reference studies, like those by Dalbar Inc., which consistently show that the average investor's returns significantly lag behind the market indexes, largely due to emotional trading, chasing returns, and panic selling.
Buy and hold disciplined approach tends to win out.
That seems to be the message. Those are all really valuable points for anyone investing. Understanding risk, staying disciplined, long-term focus. Okay, next, the book covers retirement plans, outlining options in the US and Canada. What are some of the key plans they discuss?
They start by revisiting that fundamental difference between defined benefit plans, traditional pensions promising a specific payout, and defined contribution plans, like 401ks, 403bs, RSPs, where the contribution is known, but the final payout depends on investment performance.
Man, they mentioned the passive employee problem with DC plans.
Yeah, the concern that many employees in defined contribution plans don't fully understand them. The fees, the investment options, how much they need to save. They might just stick with default options that aren't optimal for them.
Requires more engagement from the individual. What specific plans do they cover?
For the U.S., they cover individual retirement arrangements, IRAs. Both traditional IRAs, where contributions may be tax deductible now and withdrawals are taxed in retirement, and Roth IRAs, where contributions are made with after-tax dollars, but qualified withdrawals in retirement are tax-free.
Tax advantaged.
Right. They mention contribution limits, potential early withdrawal penalties, and required minimum distributions, RMDs, that typically start in your 70s for traditional IRAs. They also touch on plans for small businesses and the self-employed, like simple IRAs and SEP IRAs, and college savings plans, like the US 529 plans, highlighting the high cost of education and the tax advantages these offer.
Okay, and for Canada?
For Canada, the main ones discussed are the Registered Retirement Savings Plan, RRSP.
Similar to a traditional IRA, tax-deferred growth.
Generally, yes. Contributions are usually tax-deductible, growth is tax-sheltered, and withdrawals are taxed. They mention the options you have when you turn 71, like converting it to a Registered Retirement Income Fund, RIF, or buying an annuity, and the tax-free savings account, TFSA.
Which is more like a Roth IRA.
Exactly. Contributions are not tax deductible, but investment growth and withdrawals are completely tax-free, a very powerful tool. They compare the RRSP and TFSA, noting situations where one might be preferable over the other.
And they circle back to government programs too. Social Security.
Yes, they touch on the U.S. Social Security system, again, the funding mechanism, payroll taxes, that shrinking worker-to-retiree ratio challenge, the concept of full retirement age, which varies based on birth year, and how Social Security benefits might be taxed in retirement, depending on your other income. This can impact your overall tax bracket in retirement.
It's certainly a wide array of options. Helpful overview. They also include a section on managed growth. What's the main message there? Sounds like putting it all together.
Kind of. The central message seems to be that simply earning a high income doesn't guarantee financial success. We see people with big incomes still deep in debt, right?
Absolutely. Lifestyle inflation is real.
Right. So effectively managing your money, avoiding bad debt, and understanding how money works are crucial at all income levels. They emphasize needing both growth potential and safety in your strategy. Diversification, dollar cost averaging, rebalancing your portfolio periodically. These are key techniques for managing growth over the long term.
And they bring back those core pillars.
Yes. Reiterating the importance of leveraging tax advantages where possible and having adequate financial protection insurance as foundational elements. They even introduce a very general rule of thumb, the Formula 10-20.
10-20, what's that?
It's a suggestive guideline. Aim for life insurance coverage equal to about 10 times your annual income and aim for retirement savings totaling around 20 times your final annual income.
Okay, rough targets to think about.
Very rough, but gives people a starting point. Individual needs will vary hugely, of course.
Definitely. Finally, the book touches on other solutions like Medicare and long-term care and the really important topic of estate planning. Why are these crucial elements? Seems like they round out the picture.
They absolutely do. Medicare is obviously vital for healthcare and retirement in the U.S. The book gives a basic overview of the different parts A, B, C, Medicare Advantage, D, prescriptions, and Medigap supplemental insurance.
Navigating Medicare can be complex.
It can. Long-term care, LTC, is another huge issue, especially with aging populations. They highlight the potentially crippling costs of nursing homes or in-home care in both the U.S. and Canada. They discuss who might need it. Statistically, a lot of us will. What triggers coverage, often the inability to perform activities of daily living or ADLs, and the options like standalone LTC insurance policies or riders added to life insurance or annuities.
An expensive risk to plan for. And estate planning. Not just for the rich.
Definitely not just for the wealthy. The book emphasizes it's important for everyone. It's about ensuring your assets are distributed according to your wishes after you pass away. They discuss the difference between a will and a trust, noting that a living trust can offer benefits while you're alive and help avoid the time and expense of probate court after death. They also mention appointing an executor for your will and, crucially, a guardian for minor children.
Essential things to get in order. It really brings the whole picture together, building wealth, protecting health, ensuring your wishes are followed. The book concludes with a section titled, Saving Your Future, a Plan of Action. What are some of their final pieces of advice? The call to action.
It really boils down to mindset and habits. They emphasize the transformative power of changing how you think about money and your daily financial habits.
Like what specifically?
Urging readers to actively work on spending less than they earn, creating positive cash flow, finding ways to increase income if possible, making a conscious effort to really understand these fundamental financial principles we've been discussing.
Knowledge is power.
Definitely. Setting clear financial goals for protection, for wealth building, and having a concrete plan to achieve them. Discipline matters more than the initial amount sometimes.
And embracing change.
Yes, embracing change, expecting to succeed. Maybe changing your environment, the books you read, the people you associate with, getting out of your financial comfort zone if it's not serving you well, taking proactive steps.
So the overarching message throughout this deep dive into saving your future seems to be that building a secure financial future is indeed within reach for most of us. But it requires knowledge, proactive steps, discipline, and consistent effort over time. It's not passive.
Precisely. And the book even includes a brief food for thought section at the very end. It's quite humbling, actually.
Oh, what's the focus there?
It just briefly reminds us of the global context of poverty, suggests that even with the financial worries many of us face in North America, we are still incredibly fortunate compared to billions of people around the world. It encourages a broader perspective, maybe gratitude, and perhaps even a greater inclination towards generosity.
That's a powerful reminder. Keep our own challenges in perspective. So as we bring this deep dive to a close, here's a final thought for you, our listener, building on everything we've explored today from this book.
Yes, something to mull over.
Think about what single financial habit, if you were to implement it consistently, starting today, could have the biggest positive impact on your future, based on all the concepts we've discussed. Paying yourself first, managing debt, starting early, understanding compound interest, whatever resonates most.
Just one thing.
Identify that one thing, that one step, and maybe, just maybe, take that very first action towards building that more secure financial future for yourself.